Unlocking the Untold Money Rules for Financial Success.
20 Money Rules.
Part 2.
We appreciate your participation in Part 1, where we covered 10 essential money rules. Moving on to Part 2, we will be introducing the remaining 10 money rules. Kindly stay tuned till the end.
As a reminder of Part 1, we previously introduced the following money rules. 1. Money doesn't sleep. 2. Money is a jealous lover. 3. Money likes to be saved. 4. Money hates risk. 5. Money hates laziness. 6. Money likes speed. 7. Money is like a mirror. 8. Money is attracted to intelligence. 9. Money is attracted to the disciplined. 10. Money is a teacher.
Let's begin Part 2.
Rule 11. Save to invest, don't save to save.
The phrase save to invest, don't save to save means that it is crucial to save money with a purpose in mind rather than simply hoarding it. While saving money is important, just accumulating cash without any specific goal or plan will not lead to financial success in the long run.
The idea behind save to invest, don't save to save is that the ultimate goal of saving money should be to use it to invest in income-generating assets that can increase your net worth and provide a source of passive income. These assets could be stocks, real estate, mutual funds, or any other investment that has the potential to grow in value over time.
Investing your savings in income-producing assets can help you build wealth and achieve financial freedom. When you invest in such assets, your money starts working for you, and you can earn a return on your investment without actively doing anything. This approach can help you create a sustainable source of income, which can be particularly valuable during retirement or if you encounter financial hardships.
In contrast, if you only save money without any intention of investing it, you are essentially missing out on potential returns and not taking advantage of your money's growth potential. Therefore, it's important to save money with a purpose and invest it in income-producing assets that align with your financial goals. Rule 12. Live below your means. The phrase live below your means means that you should avoid overspending and try to keep your expenses lower than your income.
This approach can help you build wealth by allowing you to save more money that you can then invest in income-generating assets. Living below your means involves making conscious choices about how you spend your money and prioritizing your financial goals over short-term gratification.
When you live below your means, you are essentially creating a gap between your income and your expenses, which can be used to build your savings and invest in assets that can grow in value over time.
This approach can help you achieve financial freedom and security, as you are not relying on high levels of income to sustain your lifestyle.
Living below your means does not necessarily mean that you have to live a frugal lifestyle or sacrifice all luxuries.
It means that you should be mindful of your spending habits and make conscious decisions about what you choose to spend your money on.
This may involve cutting back on unnecessary expenses, finding ways to save money on essential expenses, or earning additional income through side hustles.
By living below your means and investing your savings, you can build long-term wealth and achieve financial independence. This approach requires discipline and patience, but it can pay off in the long run by providing you with a stable financial future and greater peace of mind.
Rule 13. Don't waste money on status. The phrase "don't waste money on status" means that you should avoid spending money on items solely for the purpose of impressing others or enhancing your social status.
This can include luxury items, designer clothing, expensive cars, or other material possessions that do not contribute to your long-term financial goals.
When you spend money on items to boost your status, you are essentially prioritizing your image over your financial well-being. These types of purchases may provide short-term satisfaction, but they do not contribute to building wealth or achieving financial independence.
Instead of wasting money on status symbols, it's important to focus on building financial security by investing in income-generating assets, such as stocks, real estate, or mutual funds.
By investing your money wisely, you can grow your wealth over time and achieve your long-term financial goals.
It's important to note that there is nothing inherently wrong with owning luxury items or enjoying a certain lifestyle. However, it's important to make sure that these purchases align with your values and goals and do not jeopardize your financial stability.
Rule 14. Save for a rainy day. The phrase "save for a rainy day" means that you should set aside money for unexpected events or financial emergencies that may occur in the future.
An emergency fund is a crucial aspect of financial planning because it provides a safety net that can protect you from unexpected setbacks. Building an emergency fund involves setting aside a portion of your income in a separate account that is easily accessible in case of an emergency.
This fund can be used to cover unexpected expenses, such as medical bills, car repairs, or job loss. Having an emergency fund can help you avoid going into debt or relying on credit cards to cover unexpected expenses.
It can also provide greater financial security and peace of mind, knowing that you have a cushion to fall back on in case of a financial crisis.
The amount you should save in your emergency fund will depend on your individual circumstances and financial goals.
Financial experts typically recommend saving between 3 to 6 months' worth of living expenses in your emergency fund.
Building an emergency fund may require making some sacrifices in the short term, such as cutting back on unnecessary expenses or finding ways to increase your income.
However, the long-term benefits of having an emergency fund far outweigh the short-term costs. By saving for a rainy day and building an emergency fund, you can protect yourself from unexpected financial setbacks and achieve greater financial security and peace of mind.
Rule 15. Be patient. The phrase "be patient" emphasizes that building wealth is a long-term process that requires discipline, persistence, and a willingness to delay gratification.
Achieving financial success and stability takes time, and it's important to set realistic expectations and avoid the temptation to expect overnight success.
Wealth building involves making smart financial decisions, such as saving and investing regularly, and avoiding impulsive or unnecessary expenses. It also requires the ability to stay focused on your long-term goals and remain patient even when progress may seem slow.
It's important to remember that building wealth is a marathon, not a sprint. While there may be short-term fluctuations in the markets or unexpected setbacks, it's crucial to stay committed to your financial goals and remain patient in the face of adversity.
Patience is a key ingredient for achieving long-term financial success because it allows you to stay focused on your goals, avoid impulsive decisions, and make smart choices that will benefit you in the long run.
It also helps you stay motivated and resilient during difficult times and avoid becoming discouraged by temporary setbacks.
By being patient and committed to your financial goals, you can build long-term wealth and achieve greater financial security and freedom.
While it may take time to achieve your financial goals, the rewards of financial success are well worth the effort and patience required to get there.
Rule 16. Make peace with risk. The phrase "make peace with risk" highlights the fact that building wealth requires taking calculated risks.
Investing in assets such as stocks, mutual funds, or real estate can provide higher returns than saving money in a low-interest savings account, but it also involves a degree of risk.
Taking calculated risks involves assessing the potential risks and rewards of an investment opportunity and making informed decisions based on that assessment.
It requires discipline, sound judgment, and a willingness to tolerate some degree of uncertainty and volatility in the pursuit of long-term financial gains.
Making peace with risk does not mean being reckless or making impulsive investment decisions.
Instead, it involves being willing to take risks that are commensurate with your financial goals, risk tolerance, and investment experience.
To make informed decisions about risk, it's important to educate yourself about different investment opportunities, understand your risk tolerance, and develop a sound investment strategy that aligns with your long-term goals.
While taking risks can be intimidating, it's important to recognize that risk is an inherent part of building wealth.
By taking calculated risks and making informed decisions, you can increase your chances of achieving your financial goals and building long-term wealth.
However, it's also important to recognize that not all risks are created equal.
It's crucial to avoid making impulsive decisions or investing in opportunities that are too risky or do not align with your goals and risk tolerance.
Ultimately, Making peace with risk involves striking a balance between taking calculated risks that have the potential to provide significant financial rewards and avoiding excessive risk-taking that could jeopardize your financial stability.
Rule 17. Money doesn't buy happiness, but it can buy freedom. The phrase "money doesn't buy happiness, but it can buy freedom" highlights the fact that money can provide certain benefits that contribute to our overall happiness and well-being.
While it's true that money can't directly buy happiness, having financial resources can offer more opportunities to pursue personal passions and goals, which can lead to greater fulfillment and satisfaction.
Having financial freedom can allow you to make choices that align with your values and goals, such as taking a career break to travel, starting your own business, or pursuing further education.
It can also provide a sense of security and peace of mind that can lead to greater happiness and contentment.
However, it's important to recognize that financial freedom alone is not a guarantee of happiness.
True happiness and fulfillment come from a combination of factors, including personal relationships, sense of purpose, and overall well-being.
Money can provide the means to pursue these things, but it cannot replace them.
It's also important to avoid falling into the trap of equating material possessions with happiness.
While money can provide access to certain luxuries, it's important to remember that material possessions alone do not equate to a fulfilling life.
Instead, it's important to focus on building meaningful relationships, pursuing personal passions, and finding purpose and meaning in life.
In summary, while money may not be able to buy happiness directly, it can provide the freedom and flexibility to pursue personal goals and passions that can contribute to overall happiness and well-being.
It's important to strike a balance between achieving financial freedom and focusing on the things that truly matter in life.
Rule 18. Money goes where it's treated best. The phrase "money goes where it's treated best" highlights the importance of seeking out the best investment opportunities to grow and maximize your wealth.
It means that money is always in pursuit of the most favorable conditions and returns, and it will naturally gravitate towards the best opportunities for growth and profit.
To effectively apply this rule, you need to be proactive in seeking out the best investment opportunities and be willing to take calculated risks.
This may involve conducting research, seeking out expert advice, and staying up to date with market trends and economic indicators.
By understanding the current market conditions and identifying the most promising investment opportunities, you can position yourself to attract more money and achieve greater financial success.
This may involve diversifying your investment portfolio, investing in different sectors or asset classes, or taking advantage of emerging opportunities in the market.
It's important to remember that the pursuit of high returns and profits also involves a certain degree of risk.
It's crucial to conduct thorough due diligence and only invest in opportunities that align with your financial goals and risk tolerance.
Overall, the rule "money goes where it's treated best" emphasizes the importance of being proactive in seeking out the best investment opportunities to grow and maximize your wealth.
By staying informed, taking calculated risks, and staying disciplined in your investment strategy, you can position yourself for greater financial success and achieve your long-term financial goals.
Rule 19. Invest in yourself. The phrase "invest in yourself" emphasizes the importance of continuous learning and personal development as a means of achieving success and long-term financial stability.
In today's rapidly changing job market, it's essential to stay up to date with the latest industry trends, technology advancements, and best practices to remain relevant and competitive.
Investing in yourself can take many different forms, including pursuing higher education or professional certifications, attending conferences or workshops, participating in mentorship or coaching programs, or reading industry publications and staying informed about the latest news and developments in your field.
By continually improving your skills and knowledge, you can increase your value as an employee or entrepreneur, open up new career opportunities, and position yourself for long-term financial success.
Moreover, investing in your personal and professional growth can lead to greater job satisfaction, fulfillment, and overall happiness.
It's important to note that investing in yourself requires discipline, commitment, and a willingness to learn and adapt.
It may also require taking risks, such as switching careers or starting a new business venture.
However, the benefits of investing in yourself are often significant and can pay dividends in terms of career success, financial stability, and personal fulfillment.
In summary, investing in yourself is a critical component of achieving success and long-term financial stability.
By continuously learning and improving your skills and knowledge, you can stay relevant and competitive in your career, open up new opportunities, and position yourself for long-term financial success and personal fulfillment.
Rule 20. Money is made by being in the game. The phrase "money is made by being in the game" emphasizes the importance of taking an active role in the financial game in order to generate wealth.
The rule suggests that you cannot make money passively or from the sidelines. Rather, you must be willing to learn, take risks, and actively participate in the financial markets to achieve financial success.
This rule encourages individuals to educate themselves about the financial markets, including stocks, bonds, real estate, and other investment opportunities.
It also emphasizes the importance of taking action and making investments in order to generate returns.
To effectively apply this rule, you need to be willing to learn and adapt to changing market conditions.
This may involve researching and analyzing potential investment opportunities, consulting with financial advisors or other experts, and staying informed about market trends and economic indicators.
The rule "money is made by being in the game" also highlights the importance of taking calculated risks in order to generate wealth. This may involve investing in high-growth stocks or ventures, purchasing real estate, or pursuing entrepreneurial ventures.
It's crucial to conduct thorough due diligence and carefully weigh the risks and rewards of each investment opportunity before committing your capital.
Ultimately, the key takeaway from this rule is that generating wealth requires active participation in the financial game.
By staying informed, taking calculated risks, and being willing to learn and adapt, you can position yourself for long-term financial success and achieve your financial goals. We appreciate your participation in Part 2 and anticipate your return. Wishing you a wonderful day.
This is a brand new channel. If you find any values from this video, please subscribe and like.
Your support will help us to stay motivated and keep this channel running. We are committed to providing you the best possible service.